AI stocks may be in a bubble of unsustainable spending, or we may be on the cusp of a productivity miracle. How can investors separate winners from losers? Joining me now, GMO portfolio manager Tom Hancock. Tom, great to see you. Thanks for coming on.
Oh, thanks for having me, Jack. Great to be here.
So for people who don't know, GMO has some authority on bubbles. The firm's co-founder, Jeremy Grantham, famously avoided dot-com high flyers in the late 90s, causing investors to pull out about 60% of their money, only to come running back when GMO delivered great returns through the crash. Today, you guys are looking at another possible bubble. How are you separating opportunity from hype in the AI boom?
Well, the first thing you have to ask yourself is it real? Is there real economic value? And we believe yes. But you also have to be careful about where there might be overbuilding or building of capacity before there's demand. And you want to be careful about companies that are overly exposed to that, certainly ones that have weaker balance sheets and might not be able to survive bumps along the way, which are kind of inevitable. But we do think there are a lot of great opportunities out there, and we don't think the levels of valuation are at the extremes we saw back in 1999 when Jeremy was talking about bubbles.
So there are some extreme valuations, or at least companies where you think, they're great companies, but everyone knows they're great, and so you see higher than normal valuations. On the other hand, you're not scouring the market for mediocre companies. You like what you call quality companies. How do you define that?
Yeah, the key idea for us behind quality is companies that can deploy capital, invest in the business, that means, at high rates of return, higher rate of return than if they dividended the money out to you and you put it back in the stock market or something. So to be able to do that, a company has to have some moat around their business. They have to do something that keeps competition at bay, because otherwise profits are driven down. And that's what we're really looking for. We're looking for companies with great businesses that can't be easily duplicated and with strong management that can deploy that capital efficiently.
So let's talk about a few specific stocks. One that investors are very pessimistic on right now is Salesforce. It's been a victim of the so-called SaaSpocalypse. You think that pessimism is overdone? Explain why.
Yeah, so that's the flip side of AI. I guess all the businesses that are being disrupted, and software is at the center of that, and Salesforce is at the center of that. We think there are some companies that are at risk there. But if you think about a company like Salesforce, it's really a system of record that has proprietary data, that has insights developed over 20 years, that has things basically that AI algorithms can't easily be trained on, business logic that's internal to the system, and also applications where its customers really can't afford to be wrong on. Those are going to be very hard business models to disrupt. And we think, in fact, Salesforce is much more likely to be a beneficiary than the victim of AI as they add AI capabilities to their offering, the so-called agent force that they have now.
You're also positive on Lam Research, which is kind of the other side of that coin, right? Chip makers can do no wrong right now in the eyes of investors. Does that make you nervous, and why do you like Lam?
Yeah, well, we've all seen what's happened with memory prices, and Lam is one of the semiconductor equipment makers that makes the equipment that's made to make memory. And memory itself, very capital intensive, can be somewhat commoditized. Lam, with their tools, really is in a unique position. And they're not just memory, they're advanced logic. So, think tools that are used to make the GPUs or CPUs behind AI. Lam has peers, but what Lam does, really, there's no one else who does it quite as well in steps called deposition and etch, where they specialize. And so they're kind of an arms dealer. Like if you think, I don't know, will it be Nvidia's chips, will it be AMD's chips, will it be someone else? It doesn't really matter. They're all using Lam's tools to make them.
So real quick, I want to get in two stocks that you're not so crazy about. You sold your position, long-time position in Oracle, and then Nvidia, you also think, I guess, might be overdone. Can you explain real quick why you're not crazy about those two?
Yeah. So in the case of Oracle, it gets down really to balance sheet strength, leverage, and the customer concentration they have to OpenAI in particular. And it's very easy to imagine a scenario where AI is great and OpenAI can't quite fund all the commitments they've made. They've made a lot. And Oracle, I think, is very vulnerable in that situation. So that was a stock we exited for that reason. In Nvidia's case, obviously the balance sheet's not an issue. This is a great company, and they're riding high now. But they're riding almost too high, and their margins are probably unsustainable given that there is competition coming up, whether it's from AMD or custom silicon. They're also very much exposed to delta in investment. So if a company like Microsoft were to sort of temper its investment, slow down, most of NVIDIA's revenue is the growth investment of the hyperscaler customers. And so it's very vulnerable. It's going to be very volatile. People talk about it having a relatively low PE, which is true, but I think those earnings are less certain than any of the other companies out there.
Thank you. And that's an interesting point you make between the growth part and the maintenance part. We appreciate your insights, Tom. Look to having you back sometime soon.
Thanks, Jack. It's great to be here.
Coming up, SpaceX mega IPO and Elon Musk's plan to put AI in space.